Imagine this scenario. You wake up on a Tuesday,
Right.
you pour your coffee, mindlessly scroll through your news feed on your phone, and you immediately see this massive, alarming headline.
To something scary.
Exactly. A sudden, violent conflict has broken out halfway across the world. Maybe it's near a major shipping lane or involves a huge energy-producing nation.
And it grabs your attention right away.
It does, but then, the very next morning, you're driving to work, you pull into your local gas station, step out, and you look at that digital sign.
And the price is up.
The price of a gallon of gasoline has already jumped by 15 cents overnight. You're just standing there, squeezing the handle, watching those numbers spin higher and higher, and you can't help but wonder why.
How does that happen so fast?
Right. How did an event thousands of miles away hit your wallet in less than 24 hours? And more importantly, you have to ask yourself, is that terrifying headline actually reflecting a real physical shortage of fuel on the planet right this second?
Or are you just paying invisible tax on global financial panic?
Ex-
It is arguably one of the most vital questions you can ask about the modern global economy. And the answer is almost never what the evening news suggests. I mean, we live in a world where the price of energy dictates the price of literally everything else.
Everything.
From the fertilizer used to grow your food, to the plastics in your laptop, all the way down to the cost of shipping a pair of shoes across the ocean. Understanding how that price is set is like learning the source code of the global economy.
Welcome to this deep dive. Our mission today is to peek behind the heavy velvet curtain of global finance, geopolitics, and heavy industry. We want to understand the actual physical and psychological gears that control the price of the world's most critical commodity.
We're pulling from a massive stack of research today, historical data, market analysis.
And we want to build a comprehensive picture of what actually makes the oil market tick. Because I'll be honest, the deeper I dug into this source material, the more I realized that almost everything I thought I knew about how oil is priced was fundamentally wrong.
The goal here is to equip you with a mental toolkit. By the end of this conversation, you should be able to decode those headlines like an energy insider.
100%.
We are going to separate the physical barrels of oil from the paper trading contracts. We'll look at hidden bottlenecks in the supply chain, the massive geopolitical poker games being played by producing nations, and the invisible financial forces that dictate the flow of energy.
So let's start by destroying a myth right out of the gate. The very first thing you realize when you look at the raw data is that the price of oil, this singular monolithic number that scrolls across the bottom of financial news networks,
It doesn't actually exist.
it doesn't exist. There is no one oil price, which feels incredibly counterintuitive.
It's a massive oversimplification, and it stems from a really common fallacy where people think of oil as a single uniform product, like gold.
Right, an ounce of gold is an ounce of gold.
Right. Exactly. An ounce of pure gold in London is physically identical to an ounce of pure gold in Tokyo. But crude oil is not a uniform element. It is a wildly diverse organic substance. It's essentially compressed ancient biological matter.
Dinosaur bones and algae.
Mostly algae and plankton, yeah. And depending on where on Earth it was compressed, its physical and chemical properties vary wildly.
Okay, let's unpack this. We have to look at the physical journey and the physical makeup of the stuff itself. The industry breaks this down into 3 stages: upstream, midstream, and downstream.
Precisely. Upstream is the extraction phase. This is the act of punching a hole in the ground or the ocean floor.
The drilling.
Right. It's the massive Ghawar field in Saudi Arabia, the sprawling Permian Basin in the United States, or deep water rigs off the coast of Brazil,
And then comes the midstream.
which is the logistical ballet. Oil is useless at the wellhead. It has to be moved via a labyrinthine network of pipelines, colossal ocean-faring supertankers, and massive storage terminals.
And finally, it arrives downstream.
The refining sector. And the physical characteristics of the crude oil that actually arrives at that refinery dictate everything about its value.
The technical terms for these physical characteristics are fascinating. The industry evaluates oil primarily on 2 metrics: its density, which they measure using something called API gravity, and its sulfur content.
Yes.
It sounds almost like sommeliers tasting a vintage wine. You have light, sweet crude, and then you have heavy, sour crude. Break down what those terms actually mean in the real world.
The wine analogy is actually quite fitting, because just like a grape's terroir dictates the final wine, the geological formation dictates the crude. Light refers to a low density. On the API gravity scale, water is a 10. Light crude might be a 35 or 40.
Meaning it's thin.
It flows easily at room temperature. And sweet means it has a very low sulfur content, generally less than 0.5%.
And why is sulfur such a big deal? Why do they care so much about that?
Sulfur is the enemy of the internal combustion engine and the environment. It corrodes metal, it ruins the catalytic converters in cars, and when burned, it creates sulfur dioxide.
Which leads to acid rain.
Exactly. So environmental regulations mandate that sulfur must be stripped out of the fuel before it can be sold.
Which makes light sweet crude the premium product.
It is the champagne of oil. The classic examples are the U.S. West Texas Intermediate, or WTI, and the North Sea Brent crude. Refiners absolutely love this stuff because it is relatively easy and cheap to process. You heat it up, and it easily separates into high-value products like gasoline, diesel, and aviation fuel.
But then you look at the other end of the spectrum, the heavy sour crude.
A completely different beast. Think of Canada's bitumen sands or Venezuela's Orinoco crude. It is dense, it is thick.
The research said sometimes it has the consistency of cold molasses or peanut butter.
Literally. And it is packed with sulfur and heavy metals. You can't just throw that into a standard, simple refinery.
Right. The research indicates that if you put heavy sour crude into a basic refinery designed for light sweet, it would essentially ruin the facility.
It would gum up the works entirely. A basic distillation column can't break down those massive hydrocarbon chains. To process heavy sour crude, a refinery must be equipped with incredibly expensive, specialized equipment.
Like hydrocrackers.
Massive units called hydrocrackers and coking units. These machines use extreme heat, immense pressure, and hydrogen catalysts to forcefully break apart the heavy molecules and strip out the sulfur. If a refinery hasn't invested billions of dollars to build those specific units, a barrel of heavy sour crude is virtually useless to them.
So the physical properties dictate the value, which explains why we have these different price benchmarks around the world. We aren't just looking at geographic differences, we're looking at distinct quality profiles and regional markets.
The global market primarily relies on three major benchmarks. You have Brent crude, which is a seaborne mix from the North Sea. It's light and sweet, and because it's loaded directly onto ships, it acts as the primary global benchmark, especially for Europe and Asia.
Okay, so Brent is global.
Then you have WTI, West Texas Intermediate, which represents the U.S. domestic market. And thirdly, you have the Dubai and Oman benchmark, which is a heavier, more sour crude that is absolutely critical for pricing the oil flowing into Asian markets.
Now here is where the market mechanics get really strange. You would think that in a hyper-connected global economy, these prices would move in perfect lockstep. If oil goes up in Europe, it must go up in Texas.
But that's not always true.
Right. The data shows instances where these markets completely detach from one another based purely on physical bottlenecks.
This is the ultimate proof that oil is a physical commodity constrained by steel and concrete, not just a number on a screen. Consider what happens when you have an absolute glut of production in the U.S. Midwest. Let's say the drillers in North Dakota and Texas are pumping at record highs. All that oil flows into massive storage hubs.
Like the famous one in Cushing, Oklahoma.
Exactly. But Cushing is landlocked.
Right.
The oil gets piped to Cushing, and from there, it needs to get down to the refineries on the Gulf Coast to be processed or loaded onto ships for export. But what happens if those southbound pipelines are full?
If they're operating at 100% capacity.
You have a traffic jam. A massive one. Suddenly, you have millions of barrels of crude pouring into Cushing with nowhere to go. Storage fills up. When that happens, the local WTI price, that U.S. domestic benchmark, will plummet. Producers slash prices just to convince anyone to take the physical liquid off their hands.
But wait, if oil is dirt cheap in Oklahoma, why wouldn't traders just buy it, put it on a boat, and sell it for a massive profit in Europe where the Brent price is higher?
Because of the pipeline bottleneck. They'd love to arbitrage that price difference. But the physical reality of the steel pipes gets in the way. They physically cannot move the oil to the water fast enough.
Wow.
So you end up with a fascinating scenario where the WTI price in the United States is crashing due to localized oversaturation, while the Brent crude price in London remains completely unaffected. It's sailing along at a much higher price because the European market is still tight. The global market is fragmented by its own infrastructure.
That paints such a vivid picture. We aren't dealing with a magical, borderless liquid. We're dealing with millions of tons of physical matter trapped in a highly constrained logistical web. So that establishes what the oil is and where it is. But let's pivot to the power dynamics.
The puppeteers.
Exactly. Let's talk about who actually controls how much of this stuff gets pulled out of the ground in the first place.
This brings us to the grand tug of war that dictates global supply. It is essentially a geopolitical and economic battle between two entirely different philosophies of production. On one side, you have traditional state-aligned forces, primarily OPEC and their allies, known collectively as OPEC Plus Club.
And on the other side,
You have the highly fragmented, fiercely capitalistic, debt-driven world of U.S. shale producers.
OPEC Plus is the classic cartel model. We are talking about nations like Saudi Arabia, Iraq, the UAE, and their allies like Russia. Their entire strategy relies on managing global supply through strict production quotas.
Yes.
The oil ministers meet in Vienna, they look at the global demand forecasts, and they collectively decide how much oil to pump. If they feel the price is too low, they agree to cut production.
Withholding barrels from the market to force the price up.
And if the market is overheating, they open the taps.
But the most critical concept to understand about OPEC isn't just their daily production numbers, it is their spare capacity.
Spare capacity is arguably the single most vital safety net in the global economy. So how do we define spare capacity in real terms?
It is the volume of extra oil production that a country can bring online within 30 days and sustain for at least 90 days. It is the world's shock absorber. And historically, one nation holds the overwhelming lion's share of this global spare capacity.
Saudi Arabia.
Saudi Arabia. They invest billions of dollars in infrastructure that they intentionally do not use, just so they have the ability to surge production if needed. This makes them the ultimate swing producer.
Meaning they possess the unique ability to swing the global markets single-handedly.
Yes. Because they hold this massive multi-million barrel per day buffer, any surprise announcement from Riyadh instantly sends shockwaves through the financial markets.
Let's look at the psychology of the market with that in mind.
Right. If global spare capacity is high, say, OPEC is sitting on 5 or 6 million barrels a day of unused production capability, the market is calm. Traders know that if a pipeline blows up in Nigeria or a hurricane hits the Gulf of Mexico, Saudi Arabia can simply open a few valves and replace the missing oil. There is a buffer against disaster.
But what happens when that spare capacity shrinks? What if demand is booming and OPEC is pumping at near maximum capacity just to keep the world running on a normal Tuesday?
That is when the market gets incredibly jittery. If spare capacity drops to, say, 1 or 2 million barrels a day, the safety net is gone. In that environment, any geopolitical hiccup anywhere in the world instantly translates into massive risk premiums.
Traders start panic buying.
Because they know that if a real disruption happens, there is no extra oil waiting in the wings to save them. The price spikes violently.
Okay, so OPEC Plus operates with a top-down macroeconomic strategy utilizing spare capacity. Now let's look at the opposing force. The data constantly contrasts OPEC with the U.S. shale revolution. Analysts often refer to U.S. shale as a price buffer. Why does the market view a driller in West Texas so differently than a state-owned oil company in the Middle East?
It comes down to the fundamental economics of the extraction method and the speed of capital. Traditional oil development, like a deep-water offshore platform or a massive conventional field in the desert, is a mega project.
Decades in the making.
It takes a decade of surveying, billions of dollars of upfront investment, and massive engineering feats before a single drop of oil is sold. Once those projects are built, they pump at a steady rate for decades. They are slow to start and slow to stop.
But fracking is a completely different game.
Entirely different. U.S. shale relies on horizontal drilling and hydraulic fracturing. The barrier to entry is much lower. A company can secure a lease, bring in a rig, drill a well, frack it, and have oil flowing to the market in a matter of months, not years.
That fast.
Very fast. And more importantly, these are private, fiercely competitive companies. They do not care about geopolitical strategy or global price stability. They care about their quarterly earnings and their shareholders. Therefore, they respond almost entirely to the immediate price of oil.
The elasticity is incredible. The historical data paints a very stark picture of this behavior. When the WTI price sits comfortably in a profitable zone, say between $60 and $80 a barrel, the shale industry becomes a hyperactive engine.
They secure loans, they deploy hundreds of drilling rigs, and they aggressively flood the market with new supply.
But the reaction is equally aggressive on the downside. If the global price crashes, say, dipping down toward $40 a barrel, which flirts with or falls below their break-even costs,
the shale industry slams on the brakes with brutal efficiency. They lay off crews, they stack the drilling rigs and lots, and they simply stop completing new wells.
this makes them the ultimate automated balancing mechanism.
Precisely. If prices get too high, shale producers see massive profit margins, they drill like crazy, and that flood of new supply eventually cools the market down. If prices crash, shale stops pumping, global supply tightens, and prices eventually recover.
So OPEC tries to manage the market with meetings and quotas.
And U.S. shale manages the market through sheer, ruthless reaction to the profit margin.
But there's a hidden structural danger in this system that the research highlights. We are not dealing with a static pool of oil. We have to talk about the capacity cycle and natural depletion, because pulling oil out of the ground isn't like drawing water from a lake.
This is a factor that is almost entirely ignored by the general public. Oil fields are constantly dying. The pressure inside a geological reservoir naturally drops as you extract the fluids. Without constant, expensive maintenance, water injection, and the drilling of new infill wells, natural conventional oil fields decline at a rate of roughly 3 to 8% every single year.
That number sounds small, but when you apply it to a global consumption rate of around 100 million barrels a day, the math is terrifying.
It means that the global oil industry has to discover, develop, and bring online between 3 and 8 million brand new barrels of daily production capacity every single year just to replace the oil we are losing to natural depletion.
They have to run a marathon every year just to stand perfectly still.
Exactly. And this is where the investment cycle becomes a trap. Look at the historical data from the massive price crashes, like the 2014 shale bust or the unprecedented demand shock during the COVID pandemic in 2020. What happened to the capital?
The capital vanished.
It completely dried up. When prices crash, oil companies slash their capital expenditure, or CapEx. They fire their exploration teams. They cancel the multi-billion-dollar deepwater projects in places like Guyana, Brazil, or the Gulf of Mexico because they simply aren't profitable at $40 a barrel.
But because those massive conventional projects take 7 to 10 years to build, a lack of investment today doesn't show up in the market tomorrow.
It creates a delayed time bomb. If the world stops investing heavily in finding new oil today, and the existing fields continue to naturally deplete at up to 8% a year, we are practically guaranteeing a severe, structurally bullish price spike half a decade down the line.
Because the supply just won't be there.
When global demand inevitably recovers and outstrips that shrinking supply, there is no quick fix. You can't just flip a switch and spawn a deepwater platform. The capacity cycle ensures that today's low prices sow the seeds for tomorrow's massive price spikes.
That is a perfect transition into the other side of the equation. If the complex dynamics of OPEC and U.S. shale are the engine of the oil market, demand is the steering wheel.
Good analogy.
We need to look at where all this oil is actually going, because again, the data shatters a very prevalent misconception. When most people think of oil demand, they picture millions of people filling up their sedans at the local gas pump.
It is the most visible interaction the average person has with the oil market, so it's a natural assumption. But the actual pie chart of global demand is far more diverse and complex. Yes, the transport sector is massive. It accounts for roughly 60% of global demand.
But that isn't just personal cars.
Not at all. That includes massive fleets of heavy diesel freight trucks, global maritime shipping, and the entire aviation industry.
And what about the remaining 40%?
Roughly 10 to 15% is used for power generation and heating, particularly in regions that lack natural gas infrastructure. But the really fascinating slice is the 20% that is dedicated strictly to heavy industry and petrochemicals.
Let's talk about the geography of that demand, because the landscape is shifting dramatically beneath our feet. If you look at the OECD nations, the developed, highly industrialized Western economies in North America and Europe, oil demand is essentially flatlining.
In some areas, it's even slowly contracting.
The real engine of growth, the force pulling the global price forward, is entirely located in the emerging markets.
The center of gravity for global energy has shifted decisively to Asia, and the tale of two giants here is the dynamic between China and India. For the better part of 2 decades, China has been the undisputed heavyweight champion of oil demand growth.
The raw numbers are staggering.
Between 2015 and 2024, China's total consumption grew by nearly 6 million barrels per day. To put that in perspective, that single country accounted for over 60% of the entire world's demand increase during that decade.
So the global oil market was essentially a derivative of the Chinese industrial expansion.
It was. But the data we are looking at highlights a massive plot twist arriving in the mid-2020s. The projections suggest that China's voracious appetite for oil might have finally hit a plateau or perhaps even peaked.
And the underlying reason isn't just a temporary macroeconomic slowdown or a real estate crisis. It is a fundamental structural revolution in how their society moves.
We are talking about the explosive adoption of electric vehicles, or EVs, combined with a massive shift toward liquefied natural gas, or LNG, for their heavy trucking fleet. China isn't just adopting EVs, they are scaling them at a rate that is difficult for Western observers to fully comprehend.
There is a specific data point from late 2025 that perfectly illustrates this tipping point. We have to talk about China's Golden Week.
Ice.
This is a national holiday, traditionally a period of massive, widespread travel and tourism across the country. It is essentially their equivalent to the American Thanksgiving travel rush.
Yeah.
Historically, Golden Week guarantees a massive surge in gasoline demand. But in late 2025, the data showed that gasoline demand actually dropped by roughly 9% compared to the previous year.
A 9% contraction during peak travel season is not a blip, it is an earthquake. And the analysis attributes this drop almost entirely to the deep penetration of EVs into the passenger fleet. Millions of journeys that would have burned gasoline were instead powered by the electrical grid.
The compounding effect of this substitution is massive. Long-term projections estimate that by the year 2030, the global transition to EVs and natural gas trucks could shave off roughly 5.4 million barrels per day of oil demand.
That is over 5% of total global consumption simply vanishing from the transport sector. In any normal market, losing 5 million barrels of daily demand would be a catastrophic long-term bearish signal for prices.
But the global demand story isn't just a narrative of decline, is it?
Not at all. It is a narrative of shifting geography and shifting chemistry. While China's transport demand might be plateauing due to electrification, India is absolutely stepping on the gas.
India is entering a phase of rapid industrialization, massive infrastructure build-outs, and a growing middle class that wants mobility. Projections suggest India alone could add an additional 1 million barrels per day of new demand by 2030. They're picking up a significant portion of the slack left by China's EV transition.
Exactly. And we also have to look beyond the transportation sector entirely. If we connect this to the bigger picture, remember that 20% of the pie dedicated to petrochemicals. That is the hidden titan of the oil market.
People often forget how ubiquitous petrochemicals are. We aren't just talking about plastic bags.
We are talking about the synthetic rubbers in tires, the advanced polymers in medical equipment, the synthetic fibers in our clothing, the insulation in our homes.
And perhaps most importantly, the fertilizers required to grow food for 8 billion people.
The data points to a fascinating crossover event. As the combustion engine slowly yields ground to the battery, the demand for petrochemical building blocks is surging. Industrializing nations require massive amounts of plastics and synthetics to build their modern economies. In fact, many models project that petrochemicals will officially overtake transportation as the primary driver of new oil demand growth leading up to 2030.
So oil isn't dying. The nature of what we use it for is fundamentally transforming. We are moving from burning it for motion to utilizing it as the physical fabric of modern civilization.
Absolutely right.
Okay, so we've mapped out these massive, decade-long structural shifts. We see the slow-moving tectonic plates of supply and demand. But as anyone who watches the news knows, the oil market isn't just governed by slow-moving trends.
It is highly susceptible to violent, sudden shocks. The market can be turned upside down overnight.
This brings us to the disruptors: geopolitics, choke points, and Mother Nature.
This is perhaps the most difficult aspect of the market for the average observer to parse, because it requires separating headline fear from missing physical barrels. The 24-hour news cycle thrives on amplifying geopolitical tension, but the oil market digests that tension through a very specific, cold-blooded lens.
The fundamental rule traders apply is this: does a geopolitical event merely threaten the global supply, or does it actually destroy the global supply?
Let's apply that rule to sanctions, because the data breaks down how modern financial warfare actually impacts the physical flow of oil. When we hear that a major producer, let's say Iran, Venezuela, or Russia, has been hit with massive sanctions by the US or the EU, the natural assumption is that their oil is completely cut off from the world.
We picture naval blockades, physical walls.
But the reality is much more insidious and financial. Modern sanctions are rarely about physical blockades. They are an exercise in weaponizing the global financial architecture. When Western powers sanction a nation's energy sector, they are primarily doing two things. First, they are blocking the use of the US dollar. Since oil is overwhelmingly priced and traded in dollars, losing access to the dollar clearing system makes it incredibly difficult for the sanctioned country to legally accept payment for their oil.
And the second weapon:
Insurance. The massive maritime insurance companies that provide the multi-billion-dollar liability policies required for a supertanker to operate are largely based in the West, particularly in London. If a tanker is carrying sanctioned oil, those insurers withdraw their coverage.
And without insurance.
If a tanker isn't insured, it cannot legally dock at the vast majority of major international ports. No port authority will risk a massive uninsured oil spill in their harbor.
So you can't get paid in dollars, and your ships can't get insured. It sounds like a death blow. But the data reveals a massive loophole. The oil doesn't just sit in the ground.
No, it is simply forced underground into what the industry calls shadow fleets. These are massive networks of aging, obscurely owned tankers. They change their maritime flags constantly. They turn off their tracking transponders to vanish from global monitoring system.
Going completely dark.
Going dark. They sail to international waters, often off the coasts of West Africa or Southeast Asia, and perform highly dangerous ship-to-ship transfers of crude oil in the dead of night to hide the origin of the cargo.
And they find buyers who are willing to trade outside the U.S. dollar system, perhaps using local currencies or barter, and who are willing to self-insure the risk.
Exactly. So the physical barrels of oil still flow to the global market, often ending up in refineries in China or India, but they do so much less efficiently, at a heavy discount for the seller, and with a higher inherent risk premium for the overall market. Sanctions reroute the oil. They rarely completely destroy the supply.
But there are places on the map where a physical disruption would be absolute, where no shadow fleet could save the market. We have to talk about the ultimate global choke point, the Strait of Hormuz.
If you want to understand the fragility of the global economy, look at a map of the Persian Gulf. The Strait of Hormuz is a narrow stretch of water separating Iran and Oman. At its narrowest shipping lane, it is only a couple of miles wide. Yet, roughly 20 million barrels of crude oil and refined products flow through that strait every single day.
That is 20% of total global daily consumption passing through a tiny geographical needle.
It is the single most critical economic artery on the planet. There are no alternative pipelines with enough capacity to bypass it. If the Strait of Hormuz were to be physically, permanently blocked, say by a massive military conflict or the deployment of naval mines, it would cause an immediate, unprecedented, and catastrophic global supply shock. The math is undeniable. The world cannot function missing 20 million barrels a day.
But we have to contrast the terrifying potential of that event with how the market actually reacts to mere threats. The historical data provides a perfect case study in the fear premium. In June of 2025, geopolitical tensions flared, resulting in a localized Iranian rocket attack in the region. The headlines were apocalyptic. Instantly, the price of the global Brent crude benchmark spiked violently, jumping from $69 up to $74 a barrel in a matter of hours.
That $5 jump is massive. But here is the critical distinction. The Strait of Hormuz never physically closed. The rockets did not hit the tankers. The flow of oil was never actually interrupted. Not a single physical barrel was prevented from reaching its destination.
So what were buyers actually paying for?
They were paying a risk premium. The financial traders were instantly pricing in the probability that the situation could escalate into a physical closure. It's an insurance policy against disaster. But because no physical infrastructure was actually destroyed, that premium was purely psychological. The data consistently shows that pure terror warnings, military posturing, or rhetorical threats are quickly priced into the market, causing a sharp spike.
But if no physical supply is actually taken off the board,
Gravity takes over. The traders realize there's still plenty of oil, the panic subsides, and the price eventually bleeds back down to its fundamental level.
now contrast that psychological market panic with an event that actually destroyed physical supply. And ironically, it wasn't a military conflict, it was Mother Nature. The data highlights a massive North American winter freeze that occurred in January of 2026.
Extreme weather is perhaps the most effective, albeit temporary, disruptor in the physical market. That deep freeze in January 2026 physically paralyzed the infrastructure of the Permian Basin in Texas.
How does cold weather stop oil? I thought this stuff was underground.
The oil is underground, but the extraction equipment is exposed. During a severe, sustained freeze, the wellheads physically freeze solid. The massive networks of localized gathering pipelines ice over. The natural gas power plants that supply electricity to the pumping stations fail. The infrastructure simply cannot operate. During that specific weather event, more than 1 million barrels a day of real, actual production was physically knocked offline.
That is the difference. That wasn't a psychological fear. That was 1 million barrels missing from the global balance sheet every single day the freeze lasted.
Exactly. And that creates a true, acute bullish price spike based on undeniable physical scarcity. A refinery that was expecting a delivery of crude simply didn't get it. They had to scramble into the spot market and pay whatever premium was necessary to secure replacement barrels.
We've also seen how major geopolitical events can cause permanent structural shifts in the market,
Yeah.
permanently redrawing the map without necessarily destroying all the barrels. The fallout from the Ukraine war is the prime example of this.
The sanctions regime triggered by that conflict completely fractured the historical energy relationship between Russia and Europe. For decades, massive pipelines fed cheap Russian crude directly into European refineries. Overnight, that stopped. Europe refused to buy the Russian oil, forcing Russia to pivot east.
They had to utilize that shadow fleet we talked about to send millions of barrels on a massive month-long journey all the way around the world to buyers in India and China.
The oil didn't vanish from the global balance sheet, but the entire logistical map was permanently warped. Before, oil traveled a few hundred miles via pipeline. Now it was traveling thousands of miles on aging ships. This structural shift made the global transport of oil permanently slower, less efficient, and significantly more expensive, adding a permanent logistical friction cost to the market.
And this is where it gets really interesting. This brings us to a deeply hidden, crucial layer of complexity. Let's assume the best-case scenario. Let's say millions of barrels of crude oil safely navigate the geopolitical tensions in the Strait of Hormuz. They dodge the shadow fleets, they survive the winter freezes in Texas, and they arrive safely at their destination. That crude oil is still completely useless to me, the consumer. I can't pull my car up to a supertanker and fill my tank with unrefined heavy sour crude. It has to go through the ultimate hidden bottleneck of the entire system.
The refineries. This is where the physical reality of the market becomes incredibly hyperlocalized.
This part of the research was perhaps the most eliminating for me, because we assume that if the global market is flooded with crude oil, the price of gasoline or diesel must automatically be cheap. But that is frequently untrue. To understand why, we have to look at a metric called the crack spread. What exactly is a crack spread, and why does it dictate what I pay at the pump?
The crack spread is the lifeblood metric of the downstream sector. It is the core profit margin of a refinery. Simply put, it is the financial difference between the cost of the raw material, the crude oil, and the market price of the finished products they sell, like gasoline, diesel, or jet fuel.
Why is it called cracking?
Because that is the physical chemical process they are performing. Crude oil is composed of long, complex hydrocarbon molecules. Inside the intense heat and pressure of the refinery, they literally crack those long molecules apart into lighter, shorter chains that we can burn in engines.
So a high crack spread means a refinery is printing money. They're buying crude cheaply and selling the refined products at a massive premium. But why would that spread widen? If crude is cheap and abundant, why would gasoline or diesel suddenly become incredibly expensive?
Because the refineries themselves are incredibly vulnerable bottlenecks. We discussed earlier how complex they are, especially the ones designed to handle heavy, sour crude. They are massive, multi-billion-dollar chemical plants operating under immense heat and pressure. They require constant maintenance. If a major refinery has to shut down unexpectedly due to a fire, a power grid failure, or even just routine seasonal maintenance, you suddenly lose a massive volume of the actual finished products that people need to buy that day.
The crude oil is sitting right outside in the storage tanks, but the machine to process it is broken.
Exactly. And because refined products are much harder and more expensive to transport globally than raw crude, a refinery outage creates an immediate, severe regional shortage. The local price of gasoline skyrockets as gas stations scramble for supply, even if the global price of crude oil hasn't moved an inch.
The data provides a stark example of how fragile this bottleneck can be. It highlights an incident in June 2025 involving a major refining facility in Haifa.
That facility suffered an attack that physically damaged the plant, taking roughly 200,000 barrels per day of refining capacity offline instantly. Now, in the grand scheme of a 100 million barrel a day global crude market, 200,000 barrels is a rounding error. The global Brent crude price barely registered the event. But locally, it was devastating. There was an immediate regional panic for gas oil, which is essentially the benchmark for diesel fuel. The price of that specific refined product skyrocketed in the Mediterranean basin because the physical machine required to make it was suddenly gone.
This dynamic creates what analysts call parallel markets. It's the idea that the crude oil market and the refined product market can sometimes operate in entirely different realities. The absolute best historical example of this is the European diesel crisis that unfolded between 2023 and 2025. Walk us through that because it perfectly illustrates this hidden bottleneck.
The European diesel crisis is a textbook study in logistical failure. Historically, Europe's economy ran on diesel. Their cars, their trucks, their industry. And for decades, they imported a massive percentage of their finished, ready-to-use diesel directly from Russian refineries. It was a perfectly synchronized logistical loop.
But then geopolitics intervened.
Following the invasion of Ukraine and subsequent sanctions, Europe abruptly severed that tie. They stopped buying the refined Russian diesel. Overnight, they were left with a massive structural deficit of the fuel that kept their economy running. They had to scramble to source finished diesel from much further away, bringing it in on ships from the United States Gulf Coast and mega refineries in the Middle East.
But wait, Europe has its own refineries, right?
They do-
Why did they just buy more global crude oil and make the diesel themselves?
Because of the technical limitations we discussed in the very beginning. Many of Europe's aging refineries were historically optimized and specifically calibrated to process a very specific type of medium-sour crude blend that came from Russia. When they lost access to that specific chemical profile, their refineries became much less efficient. They couldn't just pivot to processing light sweet crude from Texas and expect the same high yield of diesel. Furthermore, the European refining sector had suffered from years of underinvestment, and many plants were offline for critical maintenance.
So you have a perfect storm. Europe is desperate for diesel, their primary suppliers cut off, their import routes are suddenly thousands of miles longer, and their domestic machines aren't running at peak capacity or efficiency. What happens to the math?
The math violently detaches from the underlying crude price. By late 2025, the data notes that the European diesel crack spread hit a staggering two-year high of $33 per barrel over the Brent crude price.
$33. That is an unbelievable premium just for the refining process.
It meant that European trucking companies, farmers, and consumers were paying astronomical prices to keep their engines running. But here is the truly fascinating part that highlights the parallel market. During this exact same period in late 2025, the data shows there was actually a localized oversupply of raw crude oil sitting in the U.S. Gulf Coast. Production was booming and storage was filling up.
So you have two completely divergent realities existing on the same planet at the exact same time. You have crude oil sloshing around, relatively cheap and abundant in America, while across the ocean, European economies are suffocating under incredibly expensive diesel prices.
All because of the refining bottleneck. It perfectly encapsulates why you cannot just look at a single crude oil ticker on the evening news and assume you know what you will be paying at the pump tomorrow. The physical reality of the supply chain is simply too complex.
Okay, so we've mapped the entire physical reality. We've tracked the physical barrel from the geological wellhead, analyzed the geopolitical chess match of the cartels, navigated the shipping choke points, and survived the complex chemistry of the refineries. But to truly understand the market, we have to look at the second layer, the layer that doesn't actually exist in the physical world, but often dictates the behavior of everyone in it. We need to talk about the financial markets, algorithmic trading, and the looming ghost of inventory storage.
This is where we transition from physics to psychology and high finance. While physical supply and demand set the long-term trends, the day-to-day price of oil is ultimately discovered in the paper markets, specifically the futures exchanges in London and New York.
And when you dive into the financial data, you immediately run into two technical terms that sound incredibly intimidating, but are absolutely vital to understanding how traders view the world: contango and backwardation. We need to break these down into plain English, because they are the secret decoders of market sentiment. Let's start with contango. What does a market in contango actually look like?
Let's use a simple analogy. Imagine you want to buy tickets to a massive concert that is happening 6 months from now. If the tickets are $50 today, but you know for a fact they will be selling for $100 on the day of the show, you are highly incentivized to buy them now, hold on to them, and sell them later for a guaranteed profit. Contango in the oil market is a similar dynamic. It occurs when the price of a futures contract, the price to lock in a delivery of oil 3, 6, or 12 months in the future, is significantly higher than the spot price, which is the cost to buy a physical barrel of oil right this very second.
The future price is more expensive than the present price. Why does the market arrange itself that way, and what is it signaling?
It signals a market drowning in oversupply. It tells us there is simply too much physical oil sloshing around today, and nobody needs it immediately. Because the spot price is cheap today, but the futures market guarantees a higher price later, massive financial institutions and physical commodity traders execute an arbitrage strategy.
How does that trade actually work in the real world?
It's purely mathematical. the trader buys millions of barrels of the cheap physical oil today. They immediately rent massive commercial storage tanks on land or charter supertankers to act as floating storage. They pump the oil in, and simultaneously they sell a futures contract, locking in the higher price 6 months down the line. As long as the price difference between today and 6 months from now is larger than the cost of renting the storage tank, they lock in a risk-free, guaranteed profit.
They are essentially getting paid to hide the excess oil.
Exactly. Contango is a deeply bearish signal. It means the world economy doesn't need the energy right now, so the physical oil is piling up in the dark, waiting for a better day.
And the mathematical opposite of that structure is called backwardation.
Correct. Backwardation is when the spot price, the cost to get your hands on physical oil today, is significantly higher than the price of a futures contract for delivery 6 months from now. The present is vastly more expensive than the future.
And if contango signals a relaxed oversupply, backwardation signals pure panic.
It signals acute, immediate physical scarcity. Imagine an airline that absolutely must have jet fuel today to keep its fleet flying, or a European utility company facing an unprecedented winter freeze. They cannot afford to wait 3 months for a cheaper delivery. They are desperate. They will bid the spot price up to astronomical levels just to secure physical barrels right now.
And what happens to all that oil sitting in storage during backwardation?
The storage tanks drain rapidly. In a backwardated market, holding on to oil is a losing trade. The price is high today and expected to drop in the future, so anyone holding physical inventory is highly incentivized to sell it immediately into the elevated spot market. Backwardation is a violently bullish signal. It screams that the physical system is running on fumes.
The data gives us a fantastic, real-world look at contango by examining physical storage levels. It points to a specific period in October of 2025. The data tracks the commercial oil storage of the OECD, which essentially represents the major developed Western economies. During that month, their commercial storage levels hit a massive 4-year high of roughly 8,030 million barrels. 8 billion barrels of oil just sitting in tanks.
When commercial inventories swell to those massive levels, they exert an immense gravitational downward pressure on the global price. Those 8 billion barrels act as a massive, highly visible shock absorber for the market.
Because the traders know it's there.
Precisely. If a rebel group attacks a pipeline in the Middle East and takes 500,000 barrels a day offline, the market doesn't panic. They look at the data and say, we have 8 billion barrels in reserve. We can draw down our storage to cover the shortfall for months without any real physical crisis. High commercial inventory neutralizes geopolitical fear.
But the research is very careful to distinguish between these commercial reserves, which are owned by refineries and traders to optimize their daily operations, and strategic petroleum reserves, or SPRs. Why is that distinction important?
Because they serve entirely different masters. Commercial inventory is driven by profit and market dynamics. Strategic petroleum reserves are massive, government-owned stockpiles held in underground salt caverns by nations like the United States and China. They exist purely for national security emergencies, like a catastrophic war or a devastating hurricane that wipes out domestic infrastructure.
So the traders don't view the SPR as part of the daily market.
Generally, no. Unless a government actively makes the political decision to coordinate a massive emergency release of millions of barrels from the SPR to artificially suppress prices during a crisis, those barrels are considered locked away. Commercial storage is the true heartbeat of daily market sentiment.
And when that commercial storage on land is completely full, when every tank from Cushing to Rotterdam is topped off, the market utilizes one of the most fascinating logistical phenomena in the industry. The data calls it oil on water.
It is an incredible visual representation of a market in deep contango. When the massive concrete and steel tanks on land are full, traders have nowhere left to put the excess crude, so they turn to the maritime shipping industry. They will literally charter very large crude carriers, or VLCCs, massive supertankers capable of holding 2 million barrels each. They pump the cheap oil onto the ship, sail it out to international waters, drop the anchor, and just leave it there.
The ship becomes a floating warehouse.
Exactly. If you are an analyst tracking satellite maritime data and you see a sudden massive accumulation of fully loaded supertankers sitting stationary off the coast of Singapore or the Gulf of Mexico, it is a blaring siren. The global market is choking on oversupply, the land infrastructure has failed to absorb it, and the excess is literally spilling out into the ocean.
There is one final, invisible ghost in the machine we have to address, and it isn't even a physical commodity. It is a currency. We have to talk about the US dollar because its value acts as a massive, invisible hand steering the global oil price.
This is a fundamental macroeconomic reality. Oil is the world's most traded commodity, and it is almost exclusively priced and traded in US dollars. This creates a powerful inverse relationship between the strength of the dollar and the price of crude.
Explain how that mechanical relationship works for a buyer outside the US.
Imagine you are a refinery owner in Japan or India or the Eurozone. You generate your revenue in your local currency, yen, rupees, or euros. But when you go to the global market to buy a cargo of crude oil, you have to pay for it in US
So
dollars.
you have to exchange your currency first.
Yes, if the US central bank raises interest rates and the US dollar becomes exceptionally strong relative to other global currencies, your local currency loses purchasing power. Suddenly, it requires far more yen or euros to buy the exact same amount of US dollars.
Which means the oil becomes much more expensive for you, even if the actual per barrel price hasn't changed.
Exactly. Even if global supply and demand are perfectly balanced, a surging US dollar acts as a massive tax on the rest of the world. It kills their purchasing power, forcing them to buy less oil. Therefore, a strong dollar exerts a powerful, bearish downward pressure on the global price of crude by suffocating international demand.
So we have assembled all the pieces of the puzzle. We understand API gravity, the geopolitical quotas of OPEC, the ruthless capital discipline of U.S. shale. We've seen how EV adoption in China and surging petrochemical demand are rewriting the future. We know how vulnerable refineries dictate local prices and how contango, floating storage, and the U.S. dollar manipulate the paper markets.
We covered a lot of ground.
We did. The question is, how do we use this? How do you, the listener, apply this vast amount of information the next time you open a news app? This brings us to the Insider's Toolkit. We are going to wargame some headlines to show you how to cut through the noise.
Based on the complex dynamics we've analyzed, we can develop a critical thinking checklist. Let's run through some hypothetical yet highly realistic scenarios to demonstrate how an insider debunks common market fallacies.
Okay, let's wargame scenario A. You wake up and see a major financial headline. Global oil inventories surge to record highs. The common assumption, the fallacy most people fall into, is that record high inventory automatically equals cheap oil in a completely relaxed, bearish market. How do you analyze that?
The headline lacks vital nuance. The critical question the checklist demands is, where's that inventory and who controls it? The data explicitly warns that high inventories only exert downward pressure on prices if that oil is freely and legally available to the global market.
Give me an example of when it wouldn't be.
Let's say those record-high global inventories are heavily skewed by massive stockpiles trapped inside a heavily sanctioned country like Iran or Russia. Or perhaps millions of barrels are sitting on shadow fleet tankers floating aimlessly off the coast of Asia because they can't secure insurance or find a willing buyer with the right currency. On a spreadsheet, the global inventory looks massive. It looks like a huge safety cushion. But in reality, if a refinery in Germany or Japan cannot legally purchase or insure those barrels, that oil is effectively removed from the daily market mechanics. It might as well not exist. So, an insider knows that high absolute inventory doesn't always guarantee cheap prices if the global logistics are paralyzed by geopolitics.
Brilliant. The context of the barrel matters just as much as the volume. Okay, let's look at scenario B. This is the scary one. A breaking news alert flashes on your phone. Violent conflict erupts in the Middle East. The immediate, visceral reaction, the common fallacy, is that oil prices will instantly skyrocket and remain high indefinitely because war always means expensive oil.
This goes back to our framework of separating risk premium from physical scarcity. The checklist asks two fundamental questions here. First, is the disruption physical or purely psychological? And second, is it a temporary shock or a permanent structural change? When a conflict breaks out, algorithmic trading and financial fear will undoubtedly cause an immediate violent spike in the futures market. Traders will rush to buy, pricing in the fear of a disruption.
But the insider waits to see the physical damage.
Exactly. If the conflict involves rhetoric, localized skirmishes, or even missile strikes that miss critical infrastructure, the market eventually digests the reality. If the wells keep pumping, if the pipelines remain intact, and if the tankers continue to navigate the shipping lanes, that psychological risk premium will inevitably fade. The financial panic subsides when the physical barrels continue to arrive at the refinery.
However, the research provides a chilling counterpoint to this logic, specifically regarding the ultimate choke point. It points to a stark warning issued by the International Energy Agency, the IEA, in March of 2026.
Yes, and this is where the physical reality overrides everything else. The IEA warned that if a major geopolitical conflict were to escalate to the point of actually physically closing the Strait of Hormuz, it would instantly negate every other complex dynamic we've discussed today.
It wouldn't matter if the market was in deep contango or if U.S. shale was pumping at record highs.
None of it would matter.
Yeah.
The market could be in a years-long structural oversupply, practically drowning in floating storage. But the sudden, undeniable physical loss of 20 million barrels a day passing through Hormuz would instantly flip the entire globe into a catastrophic deficit. Geopolitics usually acts as a temporary psychological premium, but when it physically severs the main artery of the global economy, it dictates a terrifying new reality.
Let's distill this entire conversation down to an ultimate 4-point checklist for our listeners. The next time you see a terrifying or confusing headline about the energy market, run it through this filter. Number 1, is the event physical, meaning real barrels are actually destroyed or missing, or is it psychological fear driving a risk premium? Number 2, is the event global, like OPEC fundamentally changing its production quotas, or is it highly regional, like a localized pipeline freezing in Texas or a storage hub backing up in Oklahoma? Number 3, are we talking about crude oil, or are we talking about a refined product? Remember the crack spread. Is gasoline expensive because crude is scarce, or because a local refinery simply broke down? And number 4, is this a temporary shock like a hurricane in the Gulf of Mexico that will be resolved in a few weeks? Or is it a permanent structural shift, like the massive adoption of electric vehicles in China permanently destroying future transport demand?
If you internalize those four questions, you will no longer be a passive consumer of financial news. You will see past the panic of the daily news cycle, and you will understand the market through the cold, rational lens of physics, logistics, and hard economics.
Which brings us to the end of our journey today. We set out to understand what makes the oil price rise and fall in the real world. And what we found is that the oil price isn't a single number at all. It is a living, breathing, incredibly complex ecosystem. It is a constant, precarious balancing act between the political dials turned in Vienna by OPEC, the relentless, debt-driven spreadsheets of U.S. frackers in Texas, the silent electrical revolution sweeping through the streets of China, the delicate chemical tightrope walked by global refineries, and the manic, fear-driven mood swings of financial traders in London and New York.
It is, without a doubt, the single most complex, interconnected supply chain ever created by humanity, and its fluctuations shape the destiny of nations.
But before we wrap up, I want to leave you with a final provocative thought. We've spent this entire time talking about oil primarily as a resource, a fuel, and a building block for plastics. But let's extrapolate into the future, particularly regarding the intense underlying infrastructure required to power the very technology that might replace oil. We touched on how EVs are pulling demand off the oil grid and putting it onto the electrical grid. But what happens when you combine the electrification of transport with the explosive, unprecedented power demands of artificial intelligence?
The sheer scale of baseload power required by massive AI data centers is currently breaking the models of electrical grid planners worldwide.
Exactly. AI data centers cannot rely on intermittent power. They can't power down when the sun sets or the wind stops blowing. They require massive, uninterrupted, 24/7 gigawatt-scale power generation. Currently, everyone assumes the future of power is entirely renewable. But if the global electrical grid simply cannot build nuclear or renewable capacity fast enough to feed the voracious appetite of the AI revolution, could we see a bizarre, completely unpredicted renaissance? Could the desperate need for immediate, massive baseload power force the tech giants and utility companies to pivot back to heavy fuel oil power generation simply because it is the only densely packed, easily deployable energy source available on short notice?
It is a staggering contrarian thought. The assumption is that the tech industry will lead us away from fossil fuels. But if their algorithms require more power than the green grid can physically supply, the very companies building our digital future might inadvertently become the saviors of the heavy oil industry, utilizing it as a bridge fuel of last resort to prevent the AI revolution from browning out.
Will the servers running the artificial intelligence of tomorrow be quietly powered by the heavy, sour crude of yesterday? It completely flips the narrative of the energy transition on its head. Something to think about the next time you ask an AI chatbot a question or look at the price ticking higher at the pump. Thank you for joining us on this incredibly deep dive. Keep questioning the headlines, keep looking for the hidden bottlenecks, and we'll see you next time.